What's up, guys? Dom Trimboli here from Refinancer. Today, the RBA has met, and big news, it's another cash rate increase. So today we've seen 25 basis points. Probably what was expected. It's something that I was expecting. Some were saying 50 basis points could be happening, but I think given last month was 25 and we're heading to Christmas, 25 basis points is probably the expected result as it happened. Now, generally speaking, December, January, we probably won't see any increases. February, I don't think we will as well, but from that point onwards, there may be more. So I'm thinking there's about 3 months of stability. Finally, it's been 6, 7 months of consistent increases every month. So today we're just going to talk about what this kind of means for you. We're going to make it really concise. We're going to get to the point because that's how we do it here. And we're just going to talk about, I guess, what this means and what you can expect in the next 6 months. So today's news statement by Philip Lowe. It's kind of bleak the way it was announced. And it is bleak news. It's going to put Aussie families under a lot of pressure. 25 basis points, so the cash rate is 2.85%. Um, you know, inflation, the usual stuff, everything's just getting too expensive that they need to kind of calm things down. And of course, the best mechanism is interest rate increases. Now the biggest takes that I've kind of found from this is we're at 2.85% cash rate. Now that's a number that we need to remember. We're sitting at 6, 7 months ago, we're sitting at zero point 0.1. So we've gone up by 2.75% in 6, 7 months, which is beyond crazy. This hasn't happened for, decades almost in Australia. The budget was announced a little while back, right? So 25th of October. And the thing that really hit me when I was reading this, and I think this is a very, very key piece of information, was when talking about the losers in the budget, the Reserve Bank cash rate to peak at 3.35% in the first half of next year. So this is pretty reliable information that the peak is 3.35%. So let's compare that with where we're sitting as of today, 2.85%. So, you know, don't take this as financial advice. This is, of course, just my opinion and looking over some news articles, and we'll go through some other stuff. But maybe 50 basis points is all we have left. And we've gone up by 2.75%. So we may go up another 50 based on the information that's out there. So you can almost say we're almost at the end of the cycle. We've nearly hit the peak of interest rates. I think that makes sense. My prediction was always around the 5.5%, given where things had to go and given kind of how much they can get away with. If interest rates were going to get to 6, 7, 8%, the reality is people are going to sell Aussie. No one's going to afford it. You're going to have 20% of the country who are just, in arrears. The banks don't want that. It's not going to be in anyone's best interests. So that's really important. That's where the cash rate is today, the 25 basis points. Maybe we won't see a movement on this until February, March, but it's very likely that we're going to see either two hits of 25 in April, May, June, or just one big hit of 50 in March, April. And I guess the next 3 months of activity will dictate that. So I've compiled a bit of a spreadsheet, and this is what I think are just the main points that people need to be looking at. So I'll sum it up. And again, this isn't financial advice. This is my opinion. Okay. So let's kind of go over it now. Understanding the rates at the moment. Okay. So the best variable rate, now this is after the 25 basis point change. This is all in live time. It's going to be about 4.49%. And this is owner occupier too. If you're investment or you're interest only, not, we can add a little bit to that as well. So the best rate on the market is going to be about 4.49. If you've got that, in a couple of weeks, because it's going to take a little while to come into effect, you're doing really well. If you're going to refinance, you can get $4,000 with that. So again, you can refinance to 4.49%, get 4,000 cash back, and you're in the best position. So generally speaking, your current variable rate after today's news has come into effect will be about 5%. We're talking anywhere from 4.8 to 5.2. If you're in that range, you're just average. Doesn't mean you're doing great. You're not the worst, but you can still do much better. I think it's still definitely worthwhile getting from this range to that range. And if you're above this range, then really it's a no-brainer because, you're throwing away thousands of dollars in a very, very tough climate. And again, the banks are going to take some time, could be a day or two, could be a week before they actually announce these rates, before those rates come into consideration on your statements. So you're seeing these numbers and you might even be like 5%, my rate's 4.2, but trust me, in a month or two, it's going to be around here. Now, the best variable rate of 4.49 in comparison to where the best 2-year fixed rate is, it's about 5.34%. This is really important to note. So the difference between the variable and the fixed is about 85 basis points, right? So you can pretty much, if someone comes to me, Dom, I want the best deal, I'm going to say, look, 4.49 variable or 5.34 fixed. That is what any good broker or bank should be offering you right now. So the difference, again, 85 basis points. So going back to the current cash rate of 2.85%, they're expecting the cash rate again to get to 3.35. That's a 50 basis point difference, okay? So we expect that there's 50 to come in early next year. So where do we think the best variable rate is going to be after that? And it's pretty simple. We just simply add the expected 50 onto today, and we think we're going to be seeing a projected new best variable rate of 4.99. So in April, May next year, if someone comes to me, Dom, need the best deal, I'm probably going to be offering 4.99 based on the information available and what the banks might do. So should you be fixing or should you be going variable? Well, at the moment, you can get a 2-year fixed rate of 5.34 or a variable of 4.49 rising to 4.99. It's up to you whether you think locking 5.34% now is a better move than going 4.49% now, rising to 4.99. Those who are good with numbers should really understand that variable is probably looking like the winner. And again, not financial advice, just outlining some numbers. Okay. So for all you Karens, just relax. Cool. So these are the two things you need to understand right now, in my opinion, right? If I had 30 seconds with someone about home loans who owned a home, wants to buy a home, these are the two things I would just say to them. Your borrowing capacity is reducing. Refinancing or buying a property will become harder. Okay. That's so important. If if you came to me in, I don't know, March, April of this year and said, Dom, what is my borrowing capacity? I probably might, if I said $500,000 and you came to me now, it's going to be like 430,000. If you come to me in June, it could be 400,000. Your borrowing capacity may reduce by that much. So why is this important? Refinancing might be something that was possible a few months ago, but is not. It might be something that's still possible now, but isn't possible in a few months. And again, buying a property. If you're pre-approved, if you just got pre-approved and, we told you can borrow $1 million or let's say $500,000, by the time you find a property, your borrowing capacity might be 440. If you're going to auction and dropping $500,000 because you were pre-approved, if you're going to the limit, you're going to have a shortfall of, X amount. So you need to have a bit of leeway. Don't be stupid. If you're getting pre-approved for 500, don't go to an auction, spend 500 with no room for error. You need to allow for room for error right now because the banks will update their pre-approval when you get a contract. That is so important to know. Now, the second thing is your repayments are going up. Use a fraction of your newfound equity to cash out to have an emergency fund. Right? So obviously rates going up it's putting everyone under a lot of pressure because their repayments are going up. But really, let's think about this logically. Yes, your repayments are going up. Things are really tough for all of us. But you know what? We've all made lots of money on homes over the last couple of years. If you've made a 20% increase on your home in the last year or two and your repayments have gone up by a few percent, guess what? You're still ahead, right? That's the important thing to understand. Your net position is not your cash in your bank. Your net position is your cash in your bank plus your equity of your home. So what do? Refinance and cash out so you have an emergency fund. I've been saying this on repeat for 6 months, and I guarantee you this is going to be the smartest move anyone can make if they're going to be in a position where things could get a little bit tough. If your loan is 400,000, refinance it to 420, that extra 20,000, just put it in an offset account. Don't pay interest on it, but you've got that 20 grand. That's going to cover the extra repayments. And guess what? If you don't need to dip into that, great. It's not costing you anything. So trust me, if you're in a position where you don't care about repayments going up, it's not going to affect your cash flow. This might not be important, but to most Aussies, you know, we're talking 2.75% increase. It's nuts. You need to factor things like this in. So that's what I would say to you. I know it's longer than 30 seconds, but trust me, they're the two most important things to know right now. Now, another question that I'm getting asked all the time is what is going to happen to property? Now, my opinion of this is that property at the moment is actually more about supply and demand and what people can actually borrow. So I've done kind of two little curves, and this is really basic, right? It's not, I haven't gone through RP data. I've just gone through a general basis. So what can we expect property to do in the next 6 months in New South Wales, Victoria, and Queensland? And I've kind of grouped these guys together. Obviously, it might be a little bit, more, these figures might be larger in, New South Wales and a little bit less in Queensland because they're very population related. So the big thing to note about these states are there's a lot of property between this range here, right? Majority of the property is 800, $1 million, even 1.2, right? And I know, and of course, there's lots of more expensive properties, but in comparison, the great bulk of the property are sitting at prices like this. So the thing to note about this is there's lots of supply here, right? Lots of supply here. There's not going to be a lot of supply here, and there'll be less supply here. So we're talking people with investment properties in, in outer suburb, Melbourne or Sydney, worth $700,000, 800,000. Repayments are getting tough. They're going to put it on the market. There might be a lot of those types of properties hitting the market, and it might not be affordable for everyone as well. So it might fall into a bit of a weird position. So we could see some properties within this range drop from 7 to 10%. If you bought really well, obviously it might be the lower end. If you didn't buy that well, it might be the higher end. Properties within, the higher bracket where there's less supply, we might see a 2.5 to 7% decrease next year. And kind of properties within where there's less supply, like some of these cheaper properties and even some of these really expensive properties, there's kind of more, it's more nichey. There's less buyer, there's less supply, and there's less buyers. And I don't know, I don't think these properties will get affected as much. I think it'll be more where the bulk of it lies. So that's kind of what I think could be happening in New South Wales, Victoria, Queensland. And there could be great opportunity to buy within this price range because there is going to be a lot of pressure on people to sell within this price range. And what I tell my clients is you want to sell at good times and obviously buy in bad times. So if you're sitting within this range here, it's probably not going to be the best time to sell within the next 6 months. If you can avoid it, do it. How can you avoid it? Refinance, cash out on your property, tread water, sell when the next cycle happens. So moving on to, I guess, how property could move in the next 6 months in SA, Tas, WA, Canberra, Northern Territory. And again, I've lumped these guys together. Yeah, there's going to be, Northern Territory is going to be very different from SA. We've just kind of done this for a general outlook. Now, in this scenario, I don't think as many property, we won't see as much downward movement here because there's just the property prices are less expensive and there's just that's what it really comes down to. Majority of the property sits within this range here, right? There's less property here, and that's why I don't think we're going to see too much movement around this area because there's just not enough available. Again, some of these slightly, this little bracket here, I think is where we're going to see a little bit of a decrease. And even then, there'll be less properties decreasing. And to be honest, I reckon this here even might be overkill. I think there'll be a very small pocket of properties dropping 5 to 75%, a larger pocket of properties in this price range dropping. And, we might see just really property in general between 0 to 2.5%. I think we might actually see no movement in some of these places. I've got clients in you know, Canberra, Brisbane, Adelaide, sitting in this kind of range here, and they still can't find the properties they want to buy. So they've got the borrowing capacity, and for them, it's about there's just not enough on the market. And because there's not a lot of these properties out there, when they do come on the market, there are probably more buyers waiting than what is actually coming on the market as well. And what you'll find is these types of properties here are not coming on from investors. So it's unlikely you're going to see investors with properties worth 1.2, $1.4 million in these places. So they're not under pressure to sell. The investors probably have the properties worth 600,000. That's where the pressure to sell will be, because if you've got an owner occupier, an investment property, and things are getting tough, what are you selling first? Um, so I hope that kind of makes sense. And again, this is lots of generalization, right? Um, you know, there's this is kind of my opinion again. A little bit of data is matching this. This is going off what I've seen in the last couple of years, what the data I'm reading, and just the general feel that I'm getting from the market, speaking to, 2 dozen people every day who are investing, buying. Um, so I think, what should you do if you're in the category, this category here? I think you need to write it out if you can. Look at all your options. Don't be forced into a sale, just because things, if you've got equity and you can tap into it, like don't like use it. You can use that equity to have the cash flow so you don't have to be under pressure. Because the reality of cycles are once we do hit that peak, and everyone is kind of discussing the peak of here, things are probably going to go downwards. It might take a little bit of time, but once this cycle finishes, the next cycle will happen. And the next cycle might lead to lower interest rates. And we've seen what happened over the last, 12 to 36 months where property just goes crazy because things kind of don't move, in equal little increments. It's more like massive slopes and massive bursts because as soon as interest rates go down, the media hypes it up, and the market just can't keep up with the amount of buyers that are coming in. So if you can hold off selling in these areas, wait to the next cycle, and the funny thing is because rates will get lower, all of a sudden there'll be less pressure, so you probably won't feel like you have to sell. But that's where you've got to be proactive and think, okay, I'm in a good cycle now. If things didn't work out, could I handle it? If not, let's sell. So there it is, guys. That's my take on what is happening at the moment. Nothing has really surprised me over the last few months. It's kind of gone in line with how I think things were going to happen. If you watch some of the previous videos we've put out there, I think they're very much kind of, you know, in line with that as well. Again, no one knows for sure. This peak could get blown out of the water. Maybe inflation keeps rising and then things need to get readjusted. But common sense dictates that Australian families who were locking in rates of 1.89 and 1.99, they're not going to handle rate home loans of 6 or 7% because they've made all their decisions based on 2, 3%. So, that's pretty much it. And of course, we're here to help you refinance, buy a property anytime. Make sure to like, comment any questions, subscribe. I love doing these videos for you guys, so let me know if they're helpful. It does take a bit of our time, but if it's helping even one person out there, and we're actually getting lots of great feedback where people have one guy even came to us and said, one of your videos helped me about cashing out. I actually did that, and then I had a look through our database, and I'm like, this guy's not there. And he's like, oh, I did it with another broker. I'm all right, cool. So that's still fine as long as we're helping people in one way or another. All the best, guys. Till next time, and we'll catch you then.